The signs of a global financial crash are everywhere, and we'd be wise to prepare for catastrophe.
It's journalistic garbage. It's just ridiculous. If there had been as many crashes as there had been calls for imminent catastrophe, markets wouldn't be where they are now. They would never have gone up over the last 40 years. Markets climb a wall of worry. I don't ever recall in my history as an investor ever seeing a market correction being called by consensus views. If everybody's anticipating a correction, almost by definition, it's not going to happen.
Would you reposition your strategies now?
The answer is no. And the reason the answer is no is because
Neil, before we jump into the new headlines this week, last week we were talking about the momentum behind the AI boom and whether it was creeping into bubble territory. We've had another week of headlines on the topic, particularly one that I saw today from Alex Brummer at the Daily Mail, which said the signs of a global financial crash are everywhere. Gold's hit record prices and we'd be wise to prepare for catastrophe. What is your reaction to headlines like that?
Look, I think it's journalistic garbage, frankly. It's just ridiculous. Look, lots of people have called crashes in financial market commentary. I mean, if there had been as many crashes as there had been calls for imminent catastrophe, markets wouldn't be where they are now. They would never have gone up over the last 40 years. Look, I've said myself that there are bubble characteristics that I see in the AI boom, and that's not surprising. I mean, you'd expect to see that in something as ubiquitous and as sort of globally relevant as the AI industrial revolution. Okay, it would be surprising if there wasn't some degree of speculation and bubble-like activity in financial markets related to AI.
But you can see why people would be concerned if they're invested in the markets and they're seeing headlines like this. They're seeing warnings from the Bank of England. All of these people talking about, there's going to be a crash, and you see, we talked earlier in the year about Warren Buffett having a all-time high cash pile. And people start to piece this together. Why are you so sure, or what is it that you see that gives you confidence that the world is not about to have another meltdown?
Well, one sort of slightly counterintuitive thing that I think gives you confidence that the disaster is not, or catastrophe, is not just around the corner, is that so many people are talking about it now. I saw some data today which sort of measures the frequency of words like crash and market meltdown, things like that. And strangely, although the incidence of the use of those phrases has gone up, it isn't at anything like the levels that we've seen in and around market correction. So there is, I think, an increase in sort of speculation, or there's certainly been a plethora in the last few weeks of warnings about imminent disaster. But these are not sort of reaching hysterical levels yet. But one of the reasons I'm reasonably confident about this is that markets climb a wall of worry. That's an old saying in the stock market, but it's true. Markets climb a wall of worry. It's always the case that people are worried about things in the stock market, firstly. Secondly, I don't ever recall in my history as an investor ever seeing a market correction being called by consensus views. I mean, that's never happened in my experience. And that's because corrections come along as surprise events. If everybody's anticipating a correction, almost by definition, it's not going to happen because they're positioned for it. They really believe it. They're positioned for it, which means that the market is not in some sort of blowout territory. That's something to bear in mind. So in my view, the sorts of things that I think people are talking about here, where markets correct significantly, there's a sort of bursting of a speculative bubble, and that the ripple effects of that sort of bubble bursting spread out from financial markets into the real economy, and have impacts on the real economy and create a sort of recessionary real economy outcome. Those sorts of things I absolutely do not see happening in for the foreseeable future. First of all, as I said, partly because so many people are talking about it, firstly. Secondly, because I don't see the level of speculative excess that I've identified in the past, which have concerned me in the past and have led me to believe that we're about to sort of hit the buffers.
Mm-hmm.
And the other thing is that it's a widely held consensual view that basically the leading technology stocks in the US are overvalued. Now, that does mean, of course, that we know they're widely held. The Mag 7 is about, I think, something like 35% of the S&P 500. I saw some a data series out in the last few days that showed that AI-related stocks or stocks that have a particular focus on AI. JP Morgan did a calculation that 45% of the S&P is in some way, or shape, or form related to AI. This is a massively important industrial revolution. It will affect everybody's lives. It will affect the entire globe. We are in the foothills of this industrial revolution. There's a huge amount of investment going on at the moment. It's being led by the largest, best capitalized stocks in the world, businesses in the world, both in China and in the US. I don't see the sort of worrying things that led me to be very concerned about the banking system, for example, that led up to the financial crisis in 2008, 2009. I don't see those circumstances. Banks are very well capitalized. Regulation of the financial services sector, certainly regulation of banks, remains very tight. Bank capital ratios are very high. There's been no boom in bank lending. All the sorts of warning signs that I would tend to focus on that would worry me about the implications of financial market meltdowns and how the ripple effects would affect the real economy, I don't see. What I see is a part of the market that's got very excited, where there are some bubble characteristics. But interestingly, when you look at the valuation of the Mag 7 or a range of leading technology stocks in the US, and that have certainly led the US market, as we know, these stocks have led the S&P 500 over the last several years. They are nowhere near as high as the bubble valuations that preceded the tech bubble bursting in 2000. They're nowhere near as high as other sort of bubble valuation events in recent history in stock markets. So, for example, the Nifty 50, for example, back in the 60s and the 70s, those valuations were much higher on the leading stocks than are the valuations of the current of the leading Mag 7 stocks.
Talking about the sort of dot-com bubble, and I wanted to share this chart. So one of my friends sent me this chart this morning, and he asked me to see what your view of it was. But when people are going to be seeing things like this on social media all the time, and for people listening, this is a chart showing the AI bubble, in quotes, from 2023 to now versus the 1998 to 2001 dot-com bubble. And there is an uncanny similarity between the path of the two lines. Is that all that it is? Or can people read into something like this when they see it?
I think what they can read into that is there's a sort of concentrated level of excitement about AI valuations, as I've been identifying. Weirdly, I said this well over a year ago. I said that AI valuations were looking stretched, that the valuation of Mag 7 was looking stretched. And broadly, actually, the returns what's happened this year is quite interesting. Most of the return from the S&P 500 this year, and certainly from the leading tech stocks in the US, has been from earnings upgrades, not from a PE expansion. The Mag 7 has actually seen a much better earnings upgrade profile than has the rest of the S&P these are the sorts of things that I rely on when I'm looking for the things that would really worry me about the imminence of some sort of financial market meltdown. I'd have to see a whole load of things in place that I just don't see now. One of the most important would be that everybody would have to be very bullish, apart from anything else, and that's far from clear to me. In fact, quite the reverse. I mean, you wouldn't be seeing headlines like the ones you've just quoted to me if the circumstances for some sort of imminent market correction were in place.
Is there a danger that everyone believing there's about to be a crash, it becomes a self-fulfilling prophecy? Is that a thing that can happen?
I don't think so. No, I think politicians can talk an economy down, as I've already written, and I think particularly when they are politicians that lead, for example, like the Chancellor of the Exchequer, for example, in the UK, I think it's perfectly possible for politicians to shatter business and consumer confidence in their economy, and I think that's in part what's happened in the UK in recent months and years. Well, certainly over the last year. But I don't think you can talk the market down. I think there are just too many players. It's too fragmented. It's a global. I think you need to sort of recruit a global consensus, for example, which is far from clear. It is. I've advocated this myself. Technology valuations in China, for example, are nowhere near as stretched. In fact, I don't believe they are stretched at all relative to the valuations in the US. So, although they've gone up significantly in recent months, they're not in anything like bubble territory, in my view. So, yeah, I just don't think that's a credible argument, really.
If you believed in the thesis that Alex has put forward in this article, or that Andrew Bailey, or any of the sort of crash prophets, if you believed their thesis, how would you reposition your strategies now? Would you reposition your strategies, I guess?
Well, the short answer is no. Okay, so no. People talk about bubbles and market corrections as if they're all the same thing. Okay. Now, they're absolutely not. The tech bubble burst in 2000. It had very little effect on the real economy. Very little effect at all. On the other hand, the market meltdown that accompanied the financial crisis that was really a crisis born and bred in the real economy. Okay, it sort of manifested itself to some extent in financial markets, but it was the banking system that went wrong, basically, a real economy thing, that manifested itself in financial market excess, that then had a ripple effect and a massive effect on the real economy, which then lasted for years afterwards, and arguably is still, its after effects, its ripple effects are still present even today, 17 years on. So look, it depends what you mean. Not all bubbles, not all crashes are the same by any means. Clearly, Wall Street crash in the 20s, had massive impact on the banking system and the real economy. The tech bubble didn't. First of all, you've got to be clear what you mean by a market meltdown. Then you've got to think about, well, what might the after effects be if there was a correction, a very significant correction? What will the after effects be on the economy? And then you've got to sort of characterize those. The important thing is to think about, well, what do you mean by a correction, and what do you think will correct? Not everything gets blown up when a part of the stock market's valuation excess is corrected. Yeah. It might well be that other parts of the market correct upwards. So I'm not saying that might be the scenario in the future.
Yeah, of course, not every crash is the same. Not every bubble is the same.
No. So look, the quick answer to the question, I suppose, the underlying question is, how do you insulate yourself? And what would my strategy be if I was changing it or if I thought there was going to be some sort of imminent correction? How would I correct my strategy? Would I course correct my strategy? And the answer is no. And the reason the answer is no is because I am nervous about the valuations of the sort of the tech majors, certainly in the US. I've said that for over a year. I think that there are more attractive opportunities away from those parts of the stock market, and I've been writing about that continuously since. And if, as an investor, you've got a long-term investment horizon, a long-term sort of wealth creation horizon, you protect yourself, as always, by understanding what you own, understanding why you own it, being very clear about the valuation of the valuation considerations of your portfolio, whatever it is. Make sure that you're not buying overvalued stocks in your portfolio. That's what you have to make sure. High valuations are highly correlated with poor future investment returns. They're not highly correlated with market meltdowns. They're highly correlated with poor investment returns in the future. That's the thing that you should bear in mind when you're thinking about, well, where do I go? How do I insulate myself from the sort of bubble territory that we might be going into? And by the way, I think we're in the foothills of bubble expansion, if you can describe it as this. I remember there's a headline I looked at this morning from Newsweek which talks about an imminent market correction, or a market crash, actually, was the headline. That article was written in October 1998, and the market peaked in March 2000. Over the subsequent year and a half, the UK equity market, as measured by the FTSE 100, went up by 50%. So it wasn't really right, was it? There wasn't there was a market correction about a year and a half later, but if you jumped off panicking in 1998 because you read that Newsweek article and you were very worried, you'd have missed out. You'd have been kicking yourself, wouldn't you?
Yeah,
really?
Being early is the same as being wrong, I guess.
I was early and I was wrong for 2 years.
Yeah, and as we talked about last week, it almost cost you your job at the time.
Yeah, it did, yeah.
Now, I want to move on to a slightly different but parallel topic, and it's one of the things that many people are saying is a clear sign of why we're heading towards a meltdown, and that's the gold futures price breaking above $4,000 an ounce for the first time ever. Lots of people are calling that a dramatic milestone. Do you see this as just a safe haven flight, or is there something deeper? Is this people believing that perhaps global monetary order is breaking down, or what is it that is causing this move into gold, do you think?
As with most things in financial markets, it would be wrong to alight on one or two single factors that had motivated something to happen. Financial markets are infinitely complex and intricate and arcane. They're really hard to understand. What moves a market is never really clear, even in retrospect. My view look, I'm not a gold expert. I've never really understood why people want to own gold, the shiny metal. It's a rare commodity, but it has no intrinsic value. It has some value in electronic applications. It's a superconductor. Yeah, I mean, it's highly conductive. I mean, there are clearly uses for gold in certain applications, but other than, it has a store of value, but it doesn't provide an investment return. So the debate about its intrinsic value is again, you could go on for hours talking about that. I've never really understood why people want to own an asset that doesn't provide a return, other than that it is perceived as a safe haven at times of market stress. Okay. Yep. Or at times when confidence in fiat currency is diminished. Okay. So at the margin, I think some buyers of gold in the last 18 months might have been a bit concerned about, for example, Fed independence, or they might be concerned about the global confrontation between China and the US, the global sort of socio-political economic confrontation. None of these things are particularly new, by the way. But I can understand that if you were concerned about that, why you might want to buy gold, or why you might want to buy the alternative sort of, safe haven asset, which is crypto.
I mean, that is because it is ironic that people are saying that gold's run too far too fast and it's now overbought. So if you say that the markets are going to crash, but the safe haven is also overbought, then okay, now what?
Yeah, look, I am absolutely, well, as confident as I am about what I've just said about some people being motivated by genuine concerns about some of the factors that I just mentioned, might have been motivated to buy gold or crypto. But equally, I'm absolutely even more convinced of the fact that people are buying gold because it's gone up. They want to jump on that train. Okay, let's get on board. Gold's going up. Buy crypto, buy gold. It's very exciting, isn't it? Look, I've made money. They don't really know why, or they don't really know what the motivating factors are. But that is a bull market that's recruiting more people to buy gold. Gold has gone up in value, but it's hard to know whether gold is $4,000 an ounce is at the right price or the wrong price. My guess is that there is a speculative fervor in gold, as there is in crypto. Quite how that will unwind in time, I don't know. But I'm not the sort of investor who would ever want to embrace that sort of bull market phenomenon, because I don't really understand the asset and I don't understand why it's valued in the way that it is. We'll have to see. But my guess is that it's much more of a, as you've just alluded to, it's much more of a sort of speculative bubble than AI stocks are.
Okay, so I'm going to take us to the Middle East next. Some big news in the Middle East in the last 12 hours. Israel and Hamas have agreed to what looks like the first phase of a ceasefire and a hostage exchange. What has the market's reaction been to this? And do you think, is this a meaningful de-escalation, do you think?
I think the answer to the second part of the question is yes. I think it is a very meaningful de-escalation. I'm sure there are lots of really challenging negotiations to come, but this is it's a great start, isn't it? The end of conflict. It's good news, unequivocally good news. Trump clearly very excited about it, and to some extent, you have to say, well done, Donald Trump, because he's done something that nobody else appeared to be able to do.
It does appear that he's been instrumental in this.
Yeah, I think there's been a certain amount of head banging going on. I think banging of heads together, put it that way. Sorry. So I think what I'm led to believe is that the Israeli bombing of that apartment in Qatar, which killed the leader of Hamas, the current leader of Hamas's son, and there was an attempt on the leader of Hamas's the leader, was the thing that sort of encouraged Trump to sort of talk to Netanyahu and to say, look, you can't do this sort of thing. Anyway, that's what I'm led to believe by some of the insider commentary that I'm reading. But be that as it may, the point is that this is good news. Good de-escalation is significant news. Clearly peace is some way off. It wouldn't take much, I think, to reignite the war. But let's celebrate the fact that there is now a ceasefire and the hostages are coming home, which is great news. With respect to financial markets, I mean, it's hard to discern any impacts at all. The oil price is up today, interestingly, and you might normally associate a de-escalation of Middle Eastern tension with lower oil prices, not higher one. So basically, I think the impact for financial markets is very, very minimal.
Switching over to Europe, I can't keep up with this, but France appears to be in complete chaos. How dangerous is this this situation? And we talked about it a few weeks ago, but I sort of asked the same question again. Could the instability in France drag down confidence across the EU, do you think?
This is one of the most brilliant words, schadenfreude. There might be a certain amount of schadenfreude here. France, our nearest and dearest rival, is going through a sort of political nightmare at the moment. Remember, we went through our own political nightmare.
We did, yeah.
In the wake of the Brexit vote and the general election in 2017 and all the chaos in Parliament. So we've got good experience of what it's like when a minority government just can't do anything. We've had our own fair share, and Lecornu had served less than a month as PM. He couldn't form a government. He couldn't get a budget through for next year. So he's basically said, I can't do what Macron has asked. I can't do what you've asked me to do. There's a conversation I imagine he had with Macron. Macron's in a difficult position. The far left want Macron to resign. The far right want new parliamentary elections. It looks like we're not going to get parliamentary elections, new elections. It looks like we're going to get a technocratic leader, prime minister, who might be able to at least navigate a way between the political extremes, recruit enough members of parliament to vote through a budget for next year, which is the most important thing, which might deliver a deficit of something like 5% rather than the 5.5% deficit, which we're going to see this year. So a sort of watered down deficit reduction program might be deliverable for next year. And this technocratic leader might be able to put a government together, but we don't know. Apparently, that announcement is going to be made in the next 48 hours. So we'll know before the weekend if we've got a new prime minister in France, and we'll sort of know soon after that whether he can put a government together and a cabinet and all that sort of stuff.
Now, I know you don't really have any exposure in the strategies to, not much exposure to Europe at all, other than some of the car manufacturers in Germany. But do you see an opportunity here, or is this just something to sit back and watch?
No, I think French bonds reflect that sort of risk premium. The margin over German bonds is about 85 odd basis points, which is quite high. It has been higher in the last 10 or 15 years, but it's high. So to some extent, the market has priced in a degree of extra political risk in France. But in the back of everybody's mind, of course, is that the EU is the sort of, as it proved in the wake of the financial crisis, it bailed out Greece. It was, what was it who the head of the European Central Bank said, we'll do whatever it takes. And in the end, that he won, the markets lost. Markets really pushed the EU into sort of having to do some pretty extraordinary things to stand behind the financial coherence, if you like, of the EU. And I think the view is that they would do that again if it came to that. Now, France is obviously a lot bigger than Greece, and it would pose a much bigger problem. But I don't think we're anywhere near the challenges that Greece confronted in the wake of the financial crisis. So this is a bit of a sort of higher stress level for France, certainly, and for the EU. That's been reflected in financial markets already. The French equity market has underperformed the rest of the Eurozone this year, reflecting this sort of crisis. But there isn't anything near or anything like panic sort of engulfing French financial assets at all. It's all relatively calm, frankly.
Here's one that's going to rattle everybody's faith in data. The ONS admitting that it's miscalculated VAT data. I particularly like this headline: troubled ONS reveals 2 billion borrowing blunder. Now, this I know is something you've spoken about the ONS many times, ranted about the ONS many times.
I have ranted, yeah.
Does this surprise you at all, or is it just further evidence that you can't really trust what they're telling us?
Right. So I've been writing about this since April last year. So over a year and a half.
I should count how many blog posts you've done on this topic, by the way, and we should make a compendium of ONS-based blog posts, perhaps.
And indeed, last week, when the borrowing numbers came out and they looked a bit leery for, I think it was August, I wrote then about the fact that the VAT receipts just looked wrong. They weren't correlated with consumption growth. You think, well, how does VAT get generated? It's a product of the money that people spend when they buy things, services or goods. Everything is mostly vatable. There are very few things that aren't vatable, and hey presto, consumption growth should correlate very closely with VAT receipts. Well, there was an anomaly in the data that we saw last week or the week before, and I wrote about it. And hey presto, within a few days, the ONS puts its hand up once again and says, "Oh, we got it wrong. We've been miscalculating VAT receipts actually since the beginning of the year, January to August." And in fact, the total under recording, apparently, according to the ONS, is £3 billion, not the
Right.
two. The two is for this financial year. Look, I don't trust that they've even got the right number now. Frankly, the ONS is having huge problems accurately measuring what's going on in the economy. I've written about this umpteen times in relation to simple things like the number of people in work. GDP. It's not simple calculating GDP, but it's fundamentally important to calculate GDP accurately. I'm absolutely convinced that the ONS has completely misread or misunderstood what's happening in manufacturing industry and productivity in the manufacturing industry in the UK. I think the numbers just don't make any sense at all. It's rubbish. So
I want you to try and help me let people understand why this is so important, why this matters so much to you. Because I know you get frustrated and angry about this, but why does this type of mistake matter so much?
it's profoundly important. There's a maxim in business, isn't there? If you can't measure something, you can't manage it. If you can't measure what's going on in the economy accurately, how can you have the right policy settings? We at the moment, the media, the financial media, is obsessed with what's going to happen in the November budget, 26th of November. The consensus view in the media is that we face an apocalyptic economic future and that there's going to be a 20 to 30, maybe 40, the numbers are ridiculous, but a huge sort of fiscal black hole in the budget arithmetic. And this is going to be the product largely of the OBR changing its forecast for UK productivity over the next 5 years. Okay. Now, how much credibility could we attach to the OBR's future measurements of UK productivity when we don't even know what UK productivity was in the recent past? Last week, the revisions to recent ONS data resulted in nominal GDP being 2.25% higher at the end of June this year than the OBR had forecast in March. 2.25% higher nominal GDP. The OBR has to rely on what the ONS tell them when they do their sort of calculations. The OBR are getting poor data from the ONS. The ONS clearly are revising everything. They haven't measured what's going on in the economy accurately. I am particularly focused on the ONS's failure to measure productivity accurately in the manufacturing industry in particular. The historic data is rubbish, frankly, and it's not reliable. If it's not reliable, how can the Chancellor base her tax decisions at the end of November on the OBR's 5-year projection of what's going to happen to productivity in the UK economy? It's totally ridiculous as a concept. What business would behave like that? What chief executive of any business would behave like that? Would amend what they're doing today on the basis of forecasts of things that would happen over the next 5 years that is based on data that is totally unreliable?
No, you wouldn't. You just wouldn't.
It's madness. You wouldn't do that. Neither should the Chancellor of the Exchequer, Rachel Reeves, amend tax decisions, change tax policy today on the basis of what the OBR thinks might happen to productivity over the next 5 years, which we already know. The OBR has admitted, or David Miles, who is the chief economist of the OBR, has admitted that productivity measurements are an uneducated, educated guess. The Chancellor needs to set policy in the budget, fiscal policy in the budget, that is appropriate to the economic conditions that she sees today and what she thinks might happen over the next, I would say, 12 months.
No, you're absolutely right. You can't make policy off of a spreadsheet that doesn't add up. It's just not possible.
But the financial media just don't even acknowledge this. They They spend their time saying, "Oh, well, because the OBR say this, it must be true, and therefore
But
we
you
must
spotted
have an
it.
enormous black hole."
But you spotted it in the report when it came out. Without access to the underlying data, you were able to see that it didn't add up. How can all of the statisticians and all of the people that work on this get it so wrong?
Look, I'm not going to take credit for this. I am the conveyor of the message, but all the number crunching and the data analysis and the discussions that I have are conducted by an economist who I think sits alone as the best analyzer of what's going on in the UK economy. And the reason he is the best at it is because he focuses on the facts, on the data. These projections, they're incredibly arcane. Their models are very complicated. They produce lots of interesting data, but they cannot see the wood for the trees. And this is a major problem with the UK's monetary and fiscal authorities. Ben Bernanke did an analysis of the Bank of England's financial model 2 years ago and said, look, it's fundamentally flawed. You need to change. Stop relying too much on what you think is going to happen in the future because your model is wrong. Focus much more on what's happening contemporaneously in the economy and the things that you can measure accurately. And I think the same goes for the OBR. So, and for fiscal policy. So, I look, I have lots of really detailed, interesting conversations with this economist that I rely on. He's incredibly insightful. He works unbelievably hard. He's got a data set that is unrivaled, and his analysis is unrivaled because he focuses on data and facts. He doesn't base his views on what he thinks might happen over the next 5 years.
Well, he's clearly someone that knows if the data's wrong, the story's going to be wrong. So
yeah.
All right, Neil, just before we wrap up, given all of the tension around AI, bubbles, talks of market crashes and gold running wild, what's the one thing you're going to be watching next week that our listeners should pay attention to?
Okay, I'm going to be paying attention to real stuff. So the results season in the US kicks off next week. So there'll be more corporate announcements next week, particularly from the banking sector, which will be interesting. I think I'll be looking at inflation data where we get it. I think the government shutdown in the US is going to mean that some data series are not going to be published, but I'll be looking at other anecdotal and other data analysis of what's going on in the US labor market. That's going to be important. Inflation data is also going to be important because I think perhaps the most important things over the next few months towards the end of this year, I think, will be Fed interest rate policy. That will continue to be a major significant factor that will influence financial markets. And I think it will ripple that Fed policy decision-making will impact other central banks, but particularly, I think, to some extent, the Bank of England, where there is generally a sort of consensual view that there will be a cut in November, but recent commentary from some of the more sort of hawkish members of the Bank of England, MPC, have been talking about their concerns about sticky inflation, all that sort of stuff. Look, I think that, as I've said before, I think the Bank of England should have cut rates more than they already have. The sticky inflation that we're seeing is a product of frankly fiscal policy adjustments, higher taxes, higher minimum wages, packaging taxes, etc., which have pushed up particularly food prices, and what I've also referred to as administered inflation. Those, I think, are one-off impacts. They're not rippling through the economy and causing, I don't believe, inflationary pressure in the real economy. And I think the best signal of that really is what's happening to wage settlements, which are falling and are now sort of at 3% and maybe even falling below that. So, I'll be watching those sorts of things, the real economy stuff. So what are companies saying? What's happening to banks' profits? And what's happening to inflation and what the Fed's going to do.
Well, Neil, I look forward to speaking to you about all of those things next week. I think that's where we'll leave it for now.
Yep.
Thank you, as always, for your time. To our listeners, thanks for sending in your questions. If you do have a question you'd like Neil to cover next week, drop us an email, hello@w4pz.com, and we will include that in the show. Until then, until next time, take care.